Why does everyone constantly look at these charts? What does each of these bars mean? Why is one thick here and thin there? Why is one long and the other short? When and who decides that one bar should change into another? I have broken all these elements down to their molecules in this video. I will explain the meaning of every small detail and how to use it to make money in trading. Let's start with these colorful bars called Japanese candles. What are they exactly? A Japanese candle is primarily information about how the asset's price behaved over a certain period of time. For example, if we open a daily chart, one candle will represent the price movement for one day. Candles are usually shown in two colors, green and red. But what's the difference between them? If the asset's price at the end of the day is higher than at the beginning of the day, a green candle forms, indicating the asset has risen. This means that buyers were stronger than sellers. Similarly, a red candle. If the price at the end of the day is lower than the price at the beginning of the day, this means that sellers were stronger than buyers. For understanding, we can look at the chart not only for one day, but also for 15 minutes or any other time period. It's like the zoom on Google Maps. You are looking at the same area but from different distances. But why do most traders use Japanese candles? It's simple. They are the best tool for understanding price movement. A candle consists of two parts, the wick and the body. The end of the upper wick shows the highest price, and the end of the lower wick shows the lowest price for the selected period. The body of the candle is slightly different. For a green candle, the bottom part of the body is the opening price, and the top part is the closing price. For red candle, the top part is the opening price, and the bottom part is the closing price. Is this enough to understand the chart at a basic level? No. But before we dive into the details, we first need to understand what affects the price movement up or down and grasp two key concepts. Without this foundation, there is no point in looking at these charts at all. So, why does the price go up or down? For example, I want to sell my Bitcoin for $100,000. I place a sell order on the exchange. Visually, this looks like this. A list of all sell orders. Other people see that a lot of people are selling at 100K. And it's actually selling, so they place their Bitcoin at $100,100, and someone else buys it. Then the next people set their price even higher and higher. This is basically a visual demonstration of supply and demand. Sellers push the price up as long as there are buyers willing to buy at that price. And in opposite direction, the same principle applies. This is a very simplified model just for understanding. These simple breakdowns of basic tools and the best ways to earn in crypto are shared in my free Telegram channel. Recently, there was a post about coins that gave almost plus 400% in 2 trades. Link to my Telegram channel is in the description. But let's go back to the charts and candles. Concept 1. Large candle body. The body of each specified candle shows us the strength or weakness of buyers and sellers. For example, here we have two green candles. The candle on the left has a large body and relatively small wicks. The price opened here, and at the beginning sellers tried to lower the price. But they were very weak because buyers quickly intervened and pushed the price higher. Then the buyers were able to cover a large distance without pressure from the sellers, resulting in the price closing very close to the maximum. This shows us that buyers were significantly stronger than the sellers during this candle. In the second candle, the story is quite different. The price opened here and buyers started to move the price up, pushing it to a new high. but at the top sellers intervened and pushed the price down. Sellers were strong and almost completely covered the distance back to the opening price, but buyers barely managed to close the price above the opening. In this case, we see that buyers were stronger than sellers, but the difference in their strength was minimal. But what if the body of the candle is relatively larger than the wicks? This indicates that either buyers or sellers controlled the situation. On the other hand, when the body is smaller than the wicks, it indicates that both sides had much less control. And it was a tough competition between buyers and sellers. Concept number 2. Large wicks on the candle. Whenever we notice a large wick above or below the body, it gives us an important clue about price movement. What does it mean if we see a large wick above the body? It means that sellers are heavily selling at these levels, and for the price to rise, buyers will need a lot of effort. Similarly, if we notice a large wick below the body, it tells us that buyers are heavily buying at these low levels. If sellers need to lower the price, they will have to overcome these buyers. The concepts of the body and the wicks are key to understanding the main patterns of Japanese candles. Now, let's move on to the main question of trading: when to buy and when to sell. To answer this, we need to know the basic patterns, movement templates. They are like green or red lights for drivers. By the way, I recommend trading on the Bybit exchange, as I have special bonus link in the description below this video. By registering with this link and completing tasks, you can earn bonuses up to $30,000. You can also use the mobile app where you can enter these promo codes during the registration. Now let's learn about these patterns. Be prepared to review each pattern 2 or 3 times to understand it better. Feel free to rewind and listen again until it becomes completely clear. Pattern number 1. Bullish pin bar or bullish candle. This is a strong reversal pattern of Japanese candles that indicates a potential upward reversal. This candle consists of 3 elements: a small green body, a large wick below the body, and a tiny or non-existent wick above the body. How can we explain what we have just seen? The price opened around this area, and immediately sellers tried to lower the price. They were able to push the price down. But at some point, the lower prices triggered buy orders from buyers. Buyers were significantly stronger than sellers, as the sellers initially tried to push the price down, but the buyers intervened and pushed the price higher than its opening. How can this help us in a real situation? If a pin bar appears after a strong downtrend, it indicates that the sellers have lost their strength, and buyers are now stepping in to move the price upward. To start trading, we need to consider other factors to confirm our view. We will discuss this later, but if we find an opportunity to buy such a pin bar, we can place a buy order above the high of the pin bar, set a stop loss below the pin bar, and target the next level of resistance. Pattern number 2. Bearish pin bar or bearish candle. The bearish pin bar is the opposite of the bullish one. It's a red candle with a small body, a large wick above the body, and a tiny or non-existent wick below the body. It signals a reversal downtrend. What does this mean? The price opened here, and buyers started to push it up. They covered some distance and created this high. Then sellers began selling and pushed the price down. After going below the opening price, the sellers managed to keep the price below the opening, and the candle closed near its lows. At that moment, sellers gained the advantage over buyers. If we find another confirmation at this point, we can place a sell order below the low of the pin bar and keep a stop loss just above the pin bar. If you still don't fully understand how to trade technically, what stop loss, take profit, ATC are, be sure to watch this video on trading on Bybit. The video I have left in the description. Pattern number 3, Doji pattern. The Doji pattern is the only candlestick model that doesn't give us information where the price will go. It's characterized by a candle with approximately equal wicks above and below a small body. The open and close are somewhere in the middle of the candle, and the body is very small. This shows that neither buyers nor sellers were much stronger than each other during this period. Does the Doji candle tell us anything? No, it may only indicate a short pause in the movement. But if we see reversal Doji candles in a row, it means that buyers and sellers are fighting for dominance and there is easing a clearly winning side. In such situation, the price usually makes a sharp move in either direction. Now let's move on to intermediate patterns, which consist of 2 candles. Pattern number 4, Bullish engulfing. This pattern consists of 2 candles, with the green candle fully engulfing the red candle before it. Simply put, we first see a red candle, then a green one. The high of the green candle is above the high of the red one. And similarly, the low of the green candle is below the low of the red candle. What happened of the chart? Sellers controlled the situation during the red candle. When the new candle opened, the price dropped and broke through the previous low, and suddenly buyers intervened. They defeated the sellers and pushed the price above the previous high. Buyers covered a large distance than the sellers. This means that buyers now control the situation and are ready to push the price higher. To enter a trade on a breakout of the high, we can place a stop loss below the low of the candle. Pattern number 5, Bearish engulfing. A bearish engulfing is a 2-candle pattern where the red candle fully engulfs the green one. The low of the red candle is below the low of the green candle, and similarly the high of the red candle is above the high of the previous green candle. What does this mean? At first, buyers controlled the price as the price moved upward. Then, when the new candle opened, buyers tried to push the price up. They managed to break above the high of the previous candle. Then sellers saw this high as an opportunity and started selling. This pressure was so great that they were able to push the price below the previous low. Sellers covered a larger distance compared to buyers, and now the sellers took control of the market. Therefore, we can place a sell order below the low of this candle and set our stop loss above the high. Pattern number 6, Morning Star. This pattern consists of 3 candles indicating a bullish reversal. The first candle is a strong red candle with a relatively large body. The second candle is a doji with a small body and long wicks. The doji can be either green or red. Next, we have a large green candle that breaks above the high of the doji candle. The size of the green candle will determine the strength of the pattern. If the green candle is the same size as the red one, then this is a good trading opportunity. If the green candle is smaller than the red one, this is a low probability trade. Finally, if the red candle closes above the high of the red one, this is a strong reversal candle. Psychology of this pattern. We start with a red candle showing that sellers controlled the market, pushing the price down. Then the buyers intervened and pushed the price up. Finally, the sellers completely lost control, and the buyers pushed the price higher, forming the green candle. Buyers changed the situation, and now an upward move is likely. How to profit from this pattern? To enter the trade, we place a buy order above the high of the green candle. We will set a stop loss below the doji candle. Pattern number 6, evening star. This is the complete opposite of the morning star pattern. Here we see a 3-candle pattern. The first candle is green with a significantly large body, followed by a small doji candle with a small body, and then a large red candle. Psychology of this pattern. Initially, buyers controlled the situation, creating the green candle. Then sellers intervened and started challenging the buyers, resulting in the doji candle. What does the doji candle indicate? It shows that buyers and sellers are in a tug of war. And then the sellers win the battle and start pushing the price down. To enter the trade, we place a sell order below the low of the doji candle and set the stop loss above the doji candle.